Welcome to Growth Investing Mastery. Today's video is going to be about portfolio allocation, or the ideal number of companies to own. And as a reminder, this is not investment advice or recommendations to buy any stocks. Let's review our overall approach. 7 to 11 stocks is ideal, and we'll discuss some of the reasons why. We'll look at edge cases, such as owning just one stock or owning over 50 stocks. And we'll review how an index gets the same return as a market. We'll use an analogy of a computer memory flash drive, where our brain or the flash drive has 10 gigabytes, and owning each stock takes up 1 gigabyte, or in the analogy, we'd be able to store up to 10 movies on the hard drive. Some of the key considerations are that owning fewer than 5 companies will make you nervous if a company does poorly, and owning more than 20 companies will not reward enough when you make a good pick. We want to avoid the risk of ruin or losing everything. We also want a sustainable approach that can last over many years, and we need to avoid burnout and have a low-stress approach. Some diversification amongst our companies will be good, so that we're not all in on one sector or one trend. Let's look at the first edge case, which is owning just one company. And that'll be a stressful approach, as if that company goes down significantly, we're likely to be stressed. It won't allow us to sleep well at night, and I'll use that phrase, sleep well, to discuss how we want to be able to have a stress-free approach. Now, one counterpoint might be, what if we're investing in a large cap like Meta or Apple, which is relatively safe? The issue is either we pick something really safe and we don't get a lot of return, or we pick something more risky, and in that case, we get to the risk of ruin or potentially losing everything. And you'll see the financial media glorifies this all-in approach. So I remember reading a story about someone whose IRA went up to this huge amount, and it turned out they were only investing in Tesla, and they were all in on Tesla. So they had started when Tesla was a tiny company, and it turned into a big company. The issue there is there's a survivorship bias. So if Tesla had gone bankrupt, that person would have lost everything. But they got fortunate and had a big return. Risk of ruin is a real issue. And if we lose everything, it's going to be really hard to recover later. We need to consider how we're going to feel if the stock we own goes down 50%, if that's the only stock we own. So we can rule out owning one company as a viable strategy. Now let's look at the other edge case, and this is owning over 50 companies. When we own over 50 companies, we get closer to just tracking the market, and we could own an index for a similar return and do a whole lot less work. The rewards for selecting a winner when we own over 50 stocks are not that big, and there's also a massive cognitive overload, or sometimes called brain bloat, where we can't handle analyzing that many companies. There's simply no way to review 50 earnings reports in a quarter and have that be a sensible approach. We'd be reviewing multiple reports a day, or a lot of reports in a given month. There's also an issue with tracking this many companies, or doing the paperwork and accounting later. While a brokerage may give you a 1099 at the end of the year, summarizing, there's still a lot to review. Now let's look at some realistic ranges for the number of companies we can own. Between 5 to 20 companies are the first realistic ranges we can analyze. And if you own between 5 to 20, I wouldn't say you're making a mistake, but if you're getting outside of that range, you may be making a mistake. Let's try and condense that range down a bit more. Owning 5 companies can lead to an unbalanced portfolio, and we'll discuss that more in the next slide. Owning 20 companies is a lot of work, especially around earnings season. And owning 20 companies overutilizes our hard drive in that analogy, or it overutilizes our brain, and we're susceptible to brain bloat. Owning that many companies is harder to sustain over the long term and could increase our stress. And one example I have is when I owned 13 companies, I missed a company pre-reporting. That company was Natera, and they were my 11th highest allocation position, and I just completely missed they pre-reported their earnings. I found out about 3 to 4 weeks later that they had pre-reported, And I realized I wasn't really doing my due diligence on this company as I'd been focusing more on my top 10 companies. Let's examine what it looks like to own 5 companies. And here's a sample starting portfolio. We own 5 companies, A through E, and they're each 20%. However, most people have some existing stocks already, so it's unlikely to be able to create a portfolio like this unless you're just getting started. But we'll use it as an example here. So now we get really big rewards if one company does well. But at the same time, there may be some stress if one company does poorly, because each company is 20% of our portfolio. And I would add one caveat: if you're newer to investing or starting with smaller amounts, this portfolio can be completely fine, as it may be tricky to find that many great companies when you're just getting started. Now we'll take a look at one of the biggest drawbacks of owning just 5 companies. Let's take the example scenario where company A doubles, but company E loses half of its value. Now our portfolio looks like this. Company A makes up 36% of our portfolio, while company E makes up 9% of our portfolio. The 3 companies in the middle, which we assume stayed flat, B through D, make up 18% of the portfolio. The main issue is that company A has gotten to a size where it has an outsized impact at 36%. And we're again back to that issue where we may not sleep well if that 36% position has a big loss. The solution to this problem is to trim company A and start a 6th position. Now let's check out what it looks like to own 20 companies. We'll go back to the analogy of the hard drive as a person's memory. So the hard drive has 10 gigabytes, which stores movies, and each movie or stock makes up 1 gigabyte. Our brain only has so much working memory, so if we go over that 10 gigabyte limit, something has to be ejected from the hard drive or from our brain to make space. We can experience cognitive overload, where we can't handle keeping that many companies in our head at one time. This is sometimes called brain bloat as well. That energy that's spent analyzing the 21st company or maybe the 20th company is time and energy that's taken away from our higher confidence positions. We may be spending a lot of time analyzing companies which are really low allocation, and sometimes neglecting companies which are actually higher confidence positions. While I don't have any mathematical proof that this is a bad strategy of owning 20 companies, I do have the experience of a time period where I owned over 40 stocks. And what I noticed over time is that my biggest winners in my portfolio were often the top conviction positions, usually in my top 1 to 5 positions. I remember there was a case where there was a company in my portfolio and I couldn't even remember what they did. They were in the oil and gas industry, but I literally had no clue what their business was. I had purchased that company from a recommendation from a news service, but then I just completely forgot about it in my portfolio. Here's an exercise you can try at home to see if you own too many companies. Without looking, write down all your companies in the order of allocation that you own them. If you own too many companies, you're likely to forget a few companies that you own, or you may get the allocations wrong. And it's a good sign for the companies you forgot that those might not be as high conviction as you originally thought. Our ideal range of number of companies to own is between 7 to 11. And I had originally written 7 to 10, but I realize sometimes I get up to 12 or 13 companies occasionally. And this isn't a hard and fast rule. We might sometimes get down to 6 or up to 13 companies, but we want to try and stay in that kind of ideal range. I also felt 7 to 11 is a bit easier to remember than 7 to 10 because there's a store 7-Eleven, and when you play dice, 7 and 11 are winning numbers. When we own this many companies, our hard drive or our brain is at capacity and operating well. We have a reasonable cognitive load. So we have enough material to review on these companies, but not too much. And selecting a stock correctly on a large position in this portfolio will have a big impact. While selecting incorrectly or getting a poor result on one company will have an impact, but we won't have the risk of ruin. The smaller low conviction positions in our portfolio may fail, but it doesn't hurt us that much because they're smaller allocation. And just as a reminder, one more time, we want to avoid any strategy which can ruin us or take us out of the game. I've created a sample ideal portfolio here, and we have 4 high confidence positions, companies A through D. A is 18%, B 17%, and C and D are both 15%. Next, we have 3 medium confidence positions, companies E through G, making up 10%, 9%, and 7%. Lastly, we have 3 lower confidence positions, or companies we're just getting started with, and they're companies H through J, making up 5%, 3%, and 1%. Our portfolio is ordered by our highest confidence stocks, and company A is our highest confidence, while company J is our lowest confidence position. Here's one more exercise you can try at home. Assume you're starting from scratch and create your ideal portfolio with the stocks you own. How close are these to the actual percentages? If your ideal portfolio is way off from your actual portfolio, it may mean you may want to make some adjustments to your real portfolio. Now we'll take a look at some strategies for reallocation, or adjusting our portfolio. Let's say one company in our portfolio has had a huge run up and it's become closer to 25% of our portfolio. The solution is to trim 2 to 3% of the stock and reevaluate. The next scenario is that our top company A has a disastrous earnings report. Our solution is to sell the company and increase our allocations on lower or medium confidence positions. In the third scenario, we have a low confidence position which disappoints. And what we can do is simply move the money from that stock to one of our higher confidence stocks. Now let's say we find an interesting company, but we're not completely sure about them. Our solution here is to take a small starter position as we learn more. We can always change our mind later to add to the stock or to sell it if we find something we don't like about this company. Let's look at some advantages of diversifying our portfolio. Different sectors of the economy can heat up or cool down. There's some big past trends that almost everybody is familiar with. The 2000s internet era, the SaaS revolution or cloud computing revolution, and the recent AI trend. Sometimes there's smaller trends as well. For example, around 2010, fast casual dining was a big idea. I held companies such as Chipotle, Panera, and Buffalo Wild Wings, which all did really well, as fast casual dining was something which was growing. However, we want to be cautious about being all in on one sector, because it'll be really painful if there's a downturn in that sector. We are likely to invest in groupings of stocks in the same sector, as promising names emerge at the same time. For example, right now there's a lot of promising companies in the AI hardware space or in AI software space. When I think back to the SaaS or cloud revolution, I had so much SaaS companies because that strategy was working well for a while. From about 2012 to 2020, I had many big winners in the SaaS space such as Shopify, ServiceNow, and MongoDB. I also had some big winners later on around 2019 with Cloudflare and CrowdStrike. Because I kept picking winners in this sector, I ended up concentrating a bit too much on SaaS, and when SaaS went down in 2022, that was really painful as my portfolio lost a good amount. I wrote here that we'd like to keep any one sector allocation below 40% if possible, but sometimes like with SaaS, we may keep going back to the well if that strategy works well. We just want to be cautious about getting too high on any one sector. I really like this quote from Tony Robbins on what he discovered as his holy grail of investing, which he found out by interviewing all these wealthy people. He says, if we can find 8 to 12 uncorrelated assets, you can reduce your risk by 80% and still make a slight increase in your upside. However, I was somewhat critical of other parts of his book as he was recommending buying into private equity and sports clubs, which aren't really available for individual investors. But I did find this piece about diversification helpful, and I think it's interesting that a lot of wealthy people like to diversify into uncorrelated assets when possible. Summarizing our approach to portfolio allocation, owning 7 to 11 stocks is ideal, and this allows us to be able to sleep at night. We can rest well with a low stress approach, and we get big rewards when we pick correctly on a stock. We reduce or eliminate the risk of ruin, and we have a sustainable strategy for the long run. We should look to diversify when it's possible, and also reallocate to get to our closer, ideal allocations. This concludes our video on portfolio allocations. And let me know in the comments what you thought of this video, and leave me a like if you liked the video. Thank you.